Hello and welcome to FinTech Diary. My name is Amol Dethe and my guest for this chapter is Ashish Fafadia, Managing Partner, Blume Ventures. Ashish, glad to have you.
Thank you. Amol, how have you been?
Wonderful, Ashish. It's a great time to be in and in fact to understand more about the fintechs. So let me begin by asking you in terms of your profile, what kind of fintechs have you invested in? Are there any unicorn companies? What is the minimum ticket size you look at when you're investing in such companies? How many companies where you existed? And how do you see the whole, fintech ecosystem right now? So just give us a basic dashboard about Blume Ventures and the fintech profile.
Sure. So Amol, Blume is a 12-year-old fund house. We have raised 4 funds. The latest one we just closed was last year, where we raised $250+ million.
Right.
And this capital has been raised across from high-quality sovereign wealth funds and some institutions in India as well as overseas. The mandate of the fund is to invest in early-stage enterprises. And that's what we have been doing all through the last 12 years of our journey. We are 3 partners between Karthik, Sanjay and myself. And the first time we raised the fund, until now, we continue to be loyal and wedded to the early stage investment thesis. The thought process behind our investments is to come in early, and consistently you will see this pattern all across the 150 investments that we have done, that we would typically be the first institutional investor on the cap table of the company. Within the approach to investing, we clearly have 2 parts. There is the Indian domestic investments that we do, and on the enterprise side. Everything that we do is broadly tech and or innovation.
Right.
So when I say any sector or subsector or verticals, it's all indicated to be around the tech and innovation side of it.
Right.
On the domestic side, we would have about typically 60% of our investments which are targeting stories which are building around the Indian consumer and the Indian SMB.
Right.
So these are businesses which are trying to provide a tech service or a facility or a offering for either the consumer side or the businesses which are in the form of SMBs. And then there are enterprise stories, which is building the India innovation story for the world.
Yes.
So the Indian innovators, whether it is robotics, whether it is carbon capture businesses, whether it is enterprise SaaS businesses, we have had a very significant storyline building in India over the last decade plus, where initially the criticism used to be that India is largely a consumer tech market.
Yes.
And the tech was largely copycat. However, this narrative has changed very significantly in the last 7-8 years.
Right.
The last 7-8 years, it has been validated rather that we can build sophisticated SaaS enterprise companies.
Yes.
And as we talk more, I'm more than happy to tell you why I feel very strongly that India has reached this point in its journey where the global financial services and fintechs can be powered by India.
Absolutely.
So that's the journey that we have seen from the ecosystem by virtue of being there as one of the earliest players in the ecosystem.
Yes.
Coming specifically to fintech, so we are at the top, we are a generalist VC firm, like how most other VCs would be. The fundamental difference though is that we are divided amongst us across verticals. So we don't really follow this policy of find all and catch all and invest in whatever you like. The idea is for people to specialize deeply on specific areas of their interest and what are the emerging patterns.
Right.
It helps in multiple ways. On the entry side, you're able to identify the best patterns and focus. And post-investment, you're able to be the most valuable investor on the cap table of the founder and be most relevant as you handhold and support them through that activity. So we have typically also started to evolve and say that these are actually not verticals. These are more like horizontals, broad channels in which all verticals or sub-verticals will emerge.
Right.
So fintech is something that we have had investments consistently right from fund 1 days.
Okay.
And over the last 12 years, there will be almost about 18 to 20 fintechs that we have invested in.
Okay.
And some of them have done incredibly well and many more are on the path to progress.
Okay.
And when it comes to businesses that we have been incredibly proud of, includes the likes of Turtlemint, which is an insurance business. Then there is Slice and Small Case. These are some of the businesses that have scaled up relative to the others. And these are also businesses from our fund 1 and 2 days.
Yes.
And of course, then there are a bunch of others like InstaMojo, Bureau, Multiple, Aram. and a host of others which are there in the portfolio which have been doing well as well. The way we look at fintech particularly is that, like I said in the earlier part, there are two sides, which is the consumer side of it and the enterprise side of it.
Right.
Fintech also is replicating the same breakup. So you will have the fin and the tech separately. Fin is basically the financial services for the consumer.
Yes.
And the tech is the guardrails and the SaaS services that you will provide for enterprises. And then we further break this down basis the regulatory framework to which it aligns with. So on each of them will have each of these three parts, right? So it's actually a 2x3 in our lens. There'll be credit payments, including cross-border, which is all under the ambit of the Reserve Bank. Then there is insurance, including embedded insurance, assurance, etc., which is all under the IRDA. And then there is wealth and capital markets, including FX, which is all part of the SEBI largely. The FX is an as product, but the other part of FX on payments will be part of the RBI.
Sure.
And then we don't want to miss the emerging technologies. So we try and have a catch-all where you will look at things which are around Web3, blockchain, etc. But eventually the idea is to even break this and fit into one of those 6 boxes above. And where it is belonging to health as an area, it will be looked upon by the specialist in the team who's a health professional.
Sure.
So that's the way we look at fintech typically.
No, sure. In fact, you answered many of my questions already. So you started your company 11 years back. And you raised 100 crores. It took 24 months, right? While exchanging notes, you just told me that. So when I learned that, it took 24 months for you to raise 100 crores, has the time gap reduced now? And what is the difference that you see now, versus raising 100 crores 11 years back in 24 months and now?
Sure. So there are 3 fundamental shifts, right? When I put the last 2011 versus 2022 in perspective. Number one is that, yes, definitely the time has shrunk. We are comparing the world, which is kind of 2015, 16, 17 was a bridge. Pre that bridge was an era where there was no UPI, no GST, the public goods infrastructure on the financial services side. Then there was no Geo. The prices of phones and many other economic indicators and facilities like a Jan Dhan, etc.
Yes.
And post that bridge, you have all of these things that exist.
Yes.
So I would even argue that even a fund manager coming and starting up today would probably not need to spend 18 to 24 months to be able to raise that kind of capital. When it comes to, so that's the first shift, that the time has shrunk. When we look at ourselves today, when we've pulled off the $250 million fundraise that we did, we have definitely taken much, much lesser time than we took during that first fund. Of course, it helps the fact that you have raised fund 2 and 3 in between, and all the funds have been doing successfully with significant IRRs and exits which have been flowing. So the track record and the nurturing of the institution, we are hands down one of the largest team when it comes to both on the investing side as well as on the platform support to help our portfolio companies. The second fundamental shift is that the investors largely in that fund were HNIs and family offices. 80% of the fund was these people. And that included people who were new age tech founders of large companies which were emerging at that point in time, and people from the tech services world as well as old family entrepreneurs. The last 20% came from 2 institutions by the government.
Right.
When I flip it today to Fund 4 that we were talking about in the whole jump from last 11, 12 years, it is opposite.
Okay.
80% of the capital is institutions. And these are very high quality institutions both in India and globally. And the last 20% of course continues to be the family offices and HNIs and all that. And we do see that as a very important constituency. Okay. So while that percentage has flipped, when I look at it in perspective of a $250 million fund, amount has still quadrupled, and that continues to grow well.
Right.
And the third shift that has happened is the resonance to alternatives and VCs as a product. Back then, it was still an experiment for most people who were investing. When we look at it today, I would definitely be able to say that every single investor who is allocated is doing it as an asset allocation strategy and looking to get much more than the financial returns by and large, at least the institutions,
Right.
rather than just making a play and saying, let dekho kya hota hai.
Agree. When you invest in, fintech specifically, what is the horizon that you look at? How long do you invest in, and what kind of return do you expect? And also, if you could give me a sense in terms of the ticket size, what is the minimum ticket size that you look at?
So Amol, in terms of the investment horizon, that's always ranging from about 6 to 8 years. While we are coming into the company, we know fully well that we are getting into a space for long, and it will take nearly a decade for a company to start up and get to a point where it can potentially do an IPO.
Right.
So things have paced up, which means that we can afford to dream about a scenario of 6 to 8 years. It might take a little longer, which we are mentally ready and inclined to. Our fund mandate allows us to go all the way up to 10 years.
Right.
The ticket sizes typically will be in the range of about 5 crores on the lower side, all the way up to 25 crores. That's the range. However, the sweet spot is between 10 and 20.
Okay.
There'll be exceptions where we will do less than 10. There'll be exceptions where we will be happy to do more than 20 as well. And the investments are largely done in a thematic manner where we have a strong orientation to thesis. And a lot of the theses that we typically do are published in public domain as well. And we go out there and source those opportunities where there is a very deep conviction.
Right.
So if we are not very convinced that with our check size, we can get to as close to 15-20% stake into a company, we'll typically stay out. And then we typically come in full force with all of our platform support activities and initiatives, and there are a bunch of them that we power the founders with. So that's typically the way we look at fintechs and every other sector that we go into.
Right.
There are sub-variants to the strategy like the founders fund, which will do very tiny ticket sizes. And once in a while for a seasoned founder who we have known for a long time,
Right.
who has delivered an exit successfully in the past, we are happy to do even larger checks. But otherwise, the idea is to go in very early, be the first institutional investor on the cap table, and work hard in the trenches with the founder.
So, one more question here is this: that what makes you invest in a startup? How do you actually do a due diligence, or all the risk mitigations, and what actually likes you about the fintech that you take a bet on investing in that? And also, if you could add in terms of, if you like any fintech, and when you invest in it, do you also kind of support them in terms of their growth, or kind of guide them in terms of the building business models or something like that?
I'll go with what is in our head and how are we going about looking at the landscape and making our decisions. So more like I said earlier, there are thesis-driven investments and there are founder-driven investments. The thesis-driven investments are areas that we have had a chance to research deeply and made up our mind that these are the verticals or horizontals that we really want to go deep.
Right.
And as you go down building those theses and even put it out in public domain, you realize that you have now got much more clarity and it ceases to be an experiment and it actually becomes a core strategy for you. And that allows us to play emphatically and go all in while we are going down the path of investments. So the first factor that is critical is, of course, the founder and the core team that makes the company. In many other verticals around internet started businesses or internet originated businesses, digital ecosystems, it may not matter as much, but in areas which are on the deep tech side, on the fintech side, the core expertise of the founder and the track record in those verticals becomes crucial.
Right.
These are verticals, more particularly financial services is highly regulated as an area and very nuanced. It does not give you too many chances to stumble and come back. So the attention that the founder has to give to nuances is very, very high. And it only comes with experience. So the background of the founding team and the overall execution capability that they would bring to the table becomes the core of the conversation. The other factors that can the teams come together and build a large team, can they stick together, are par for the course. That will apply to everything else.
Right.
Also, I personally do have a bias that not big fan of going and burning huge sums of money in the formative stages of the business. As you are developing a certain product, at some point in time, it has to come out for people to play with or enterprises to adopt. And then you build it from there on. Because it's more so even now in this age where the regulations are changing the way they are changing, it's actually evolution tech. There is going to be a significant evolution, and you will actually start talking about 2021 to 23 as a bridge, where a host of changes happen sweeping manner across multiple regulators. We saw last year was a time when RBI had a host of changes across various parts of its ecosystem. And there are things which are coming up from the other regulators as well, and will continue to do so. That's what will strengthen the ecosystem and make it even deeper, hopefully. But in the process, there will be a lot of upheaval and friction. So these factors do dominate our thinking as to how the founders are going to absorb these. How can they build efficiently? The second is the market. It is very critical to understand that we are entering that era of our economic development where niche exits will be there, but those are accidents. Fundamentally, when an institution is looking at investing, the focus would be on innovation, yes, but can this innovation be applicable to a large constituency of the market? You might be willing to take a bold call, which we do all the time, that it might look like a small market today, but eventually is this going to explode and become big enough? And that's where I go back to my thesis orientation. When you have worked deeply in that area and done your homework pre the meeting with the founder, you really are able to estimate and say, okay, this is not big enough a market today, but it can be big enough. So then you can make your own conviction-led bet. There's no point in trying to spend 6, 7, 8 months with the founder, going deep down and then saying, I can't invest. That you would do to make more conviction on seeing the scale of the business, maybe, but not to understand the business. That's something that has to come innate to you beforehand. So these are the two factors.
I think important parameters.
And the third factor that becomes critical is how fundable the sector is. So if there are changes that are happening, are the investors who are going to come in and follow on? Or you're going to underwrite the growth from here on? In VC funded businesses, you're looking at a pace which is very disruptive, and it has to come at a frugal cost. So then you want the company to be able to check the boxes and be able to raise follow-on capital as well. So what you are going to underwrite and take that company to in terms of the next milestone is what you can talk about. But eventually it will need more capital. So then you will also try and assess as to your appetite in depth to go further, or eventually how much capital the markets may need to pour in to take this company to the next level. So these are the three factors. First two are 80%. There's a little bit of that last 20% which comes in the bias on how fundable the sector is. And you then keep out FOMO. Don't go into verticals where just because the market is investing, you're going into it.
So efficiency in product matters.
Absolutely.
The most. You have to see whether the founder is busy and utilizing his efficiency building the product, or is far more efficient in having coffees.
Most founders don't, but yeah, you're right. The idea is to make sure that there is orientation to product efficiency.
Absolutely. Meaningful thoughts, Ashish. Let me shift your focus specifically on the fintech side right now. Most of the startups, fintechs, are now complaining that, there is enough dry powder available with the investors, whether we see angel investors, but it's not that they are able to access it. Because of, the funding winter is real, is what we learned. What is your view on the funding winter? Are you going slow in terms of investments? How are you reviewing the current situation? Have you added more filters to maybe the risk mitigation or the due diligence of the startups, fintechs where you're investing, because of the market is not very supportive?
So Amol, winter is there for real, but we'll also have to add a little more dimension to it. So maybe 30 seconds on that before I jump straight into the deep end of your question. The last year, which people are comparing and counting this as a winter, was an aberration. And let's face it, when liquidity goes in such a large quantum, it was not healthy. It did allow people to burn crazy money, sometimes unaccounted literally in terms of getting results. But at the end of the day, when you look at things today, it is just forcing people to build a lot more efficiently. So if that's what we call as winter, I would say it's okay. Let's put in perspective that India is not a winner-take-it-all market. Different verticals and sub-verticals exist. And within the market, there are different sub-geographies and consumer sets that exist. So one can build and really be a market leader in some or the other and still make a great business model out of it. Specifically, we are not holding ourselves back. We have been typically investing at the steady pace all through the last 8-9 years. We were a little more prolific in the first 3 years of our investment journey, but all through 2014 till date, we have at a consistent pace at which we have been investing and will continue to. In the last 12 months, we have invested in 2 fintech businesses, Multiple and Aram. And we are definitely looking closely to add one more very soon, and maybe 1 or 2 more thereafter. So this year we'll see at least 3 investments on the fintech side. And there is one investor, one vertical. Likewise, there are 4 other members in the team as well, and they'll be looking at adding their stuff too. So not going slow, because on the early stage side, the overall interest continues. One can say that because of the regulatory changes, people are a lot more conscious as to what they want to fund. So if the vertical or the business has a very significant question mark on a potential regulatory change that could hit, or there's a regulatory arbitrage which the business has been able to operate on, people are definitely going to be fairly wary of. And at the same time, people are also questioning the fact that if eventually everything is going to monetize itself through credit, which has been the norm.
Yes.
For a long time in fintech, you had only payments and credit. Yes. That was equivalent to fintech in the formative years.
Absolutely.
Which is fine. That's how the market was. But if eventually payments is not an area where companies can monetize, and we have seen this, it's proven by far.
Yes.
And eventually everything has to move towards credit as an area of monetization, and how well the business can underwrite and grow is a factor that people are wanting to see and experience before they will cut generous quantums of check. There are a lot of other avenues where attention is going, areas around insurance, there is areas around wealth, then there is things around application layers of technology like blockchain, etc., where people are excited. So I honestly am not too worried about the winter, more so at the early stage that we operate into. And from the growth lens, the message is very clear: build more efficiently and you will be fine.
Interesting thoughts here, Ashish. But tell me something. Will you invest only in 3-4 segments that you said, or will you also explore a few more segments? Or let me rephrase. Most of the fintechs now are heading towards only and only credit. Like you said, payment is not more efficient. They could not monetize. And that's the reality. So majority of the fintechs operating today are into credit space, and those who are not even credit are thinking about entering into that space. So how do you see the whole fintech space right now? Because ultimately you will work as a credit aggregator, and you will have some partnerships and collaborations with the banks. So even the money that you will make will also have limitations because of the commission that you will charge. So do you see the fintechs will have a successful and, more importantly, a profitable business model?
Every business model that is seeking funding has to have orientation to profitability, right? So fintech is not going to be any exception. More so in fintech. It's very easy to get carried away by saying that I'm processing GTV of so many hundreds of crores. But if your take rate in that is 1% or 2%, that's what your revenue is. And that's what the genesis of the market size computation should be.
Right.
When it comes to us, the investments that we have made are not credit. So the orientation is not to just look at the lowest hanging fruit. If you are looking at building businesses of the future, you will looking at business that will scale up from 2023 onwards over the next decade. And we are as underpenetrated on wealth solutions. We are as underpenetrated on insurance. We are as underpenetrated when it comes to security for our institutions, which is the banks, insurance companies, brokerages, etc. So there are many avenues. which are clearly there up on the anvil.
Right.
And like I said, it is not just credit for us, it's actually 6 of those boxes, the 2x3 that I explained earlier. On the infra side, there is 3, and then there is on the consumer financial services side, there are 3. So we are actively working on each of those 5 boxes other than credit. So far as they have a strong value prop standalone on the back of the promise of the box that they stand in, we are more than happy to look at it. And as an example, I told you, none of the two are going to make their core wealth using credit as a base. It's going to be an element for sure. When you are looking at building a platform, there will be many things that will get plugged into. But that is not the genesis. However, the growth capital that we put into some of the companies that are doing well are invested over the last 4 or 5 years. And we typically go and double down in these companies by raising an opportunity fund or offering it to our investors to invest more on our behalf.
Right.
There, the credit businesses in the portfolio like a Jai Kisan, etc., are doing very well. There's a Stellapps, there's a business called Stellapps in Bangalore on the milk supply chain. And they have been also performing, doing a great job. So those businesses were in investments of the last few years, and they have started to take off. Now we're adding newer areas of thesis like solar, which is what ARM is going after. We're getting into this theme of saving now, the contra of a BNPL.
Yes.
Multiple is an example of that. So the idea is to get into models of the future and not just be trying to catch the low-hanging fruit.
So partly you told me about the investments that you're planning for 2024, 2023 this year. But going ahead, considering the background of the whole economy, the regulatory challenges and the changes that happened, during the last 3 to 6 months in the country and the funding winter, how do you see the whole fintech ecosystem in maybe next 1 to 2 years, and specifically in 2023? Do you see consolidation happening? Do you see most of the fintechs, those who raised lots of funds, will have a tough time proving the value for the money which they raised?
Answer to both of your questions, in my personal opinion, is a big yes. We will definitely see that there will be some degree of pressure the highly funded businesses will face, not because of the funding that they have raised, but because of the valuations they have raised at. The good news is the fact that if you have high valuation and high dose of funding, you have time to get into that valuation.
Right.
Startups in general always raise with the promise of the future. So you have to flow into that valuation. So this is not a problem of fintechs alone. This is a problem with every company which has been valued at upwards of 100, 200, 300 million dollars. So when you are able to flow into that valuation with efficient measures and add more dimensions to your business and convert your positive unit economics into your genuine spreads and margin structures, we are definitely going to be in good shape. It might not multiply the way it multiplied over the last 3 years, and that's fine. So far as a scaled up company is able to compound and grow at the rate of about 25 to 35%, it's a great job. I don't think anybody would complain if a unicorn or a sunicorn has grown at that kind of a pace, provided it can build efficiently and percolate the revenues all the way to the bottom line.
Right.
Consolidation, if the company does run out of money and it has a significant exposure in financial services, it is a big exposure. It's not trading or a services or a tech shop where you can shut it and close out efficiently. There are consequences of a credit business shutting down. So the only way out there for inefficient businesses for consolidation. I am not too worried about lack of spaces to invest. Regulation always trails innovation.
Yes.
We have had innovative business models come all the way from 2011 to 2022, more aggressively on the financial services side from 2015 till now. And the big opportunities are actually now emerging because there is much more clarity. So one can see that if there is a whole element of our own crypto being layered and sponsored by the government through the CBDC, it is actually a very welcome step for cross-border payment opportunities. One can actually imagine that we will be able to, as a country, hold on our own by strengthening our position as a currency, as well as our monetary services systems, etc., which are today dominated by barely 2, 3, 4 global institutions. The money that is lost out in remittances with just 2 or 3 pockets, which are capturing everything globally in global trade, can now be leveraged by Indian players as well.
Right.
So as you are seeing an onslaught of regulation, yes, we are seeing a fair bit of friction between incumbents and the fintechs. That needs to be addressed more than the regulation, because regulation is only going to make the whole avenue much more stable and long lasting. So it's time to embrace it, adopt and move into it, and look at the opportunities that are emerging because of things like CBDC, ONDC, etc., and what we can do with it.
Sure, Ashish, I'm done with my questions. Thank you so much for sharing remarkable thoughts on the fintech ecosystem, and also, your areas and your expertise in terms of how you select and choose fintechs to invest in. So thank you so much for your time and sharing these insights here.
Thank you very much, Amol. It was a pleasure talking to all of you.
Thank you. And thank you so much for watching etbfsi.com and the special episode FinTech Diary. Thank you so much.